Hello, everybody, and welcome to today's session. We're here to discuss the ongoing revision of the Greenhouse Gas Protocol and to share Nvalue's perspectives on the latest updates. I'm joined today by two of my colleagues, Iglika, Senior Manager for Climate Markets and Policy Analysis at Nvalue, who leads our work on regulatory developments and climate policy trends.
Hi, everyone.
And second, Dania, who oversees Nvalue's group investment strategy and market positioning, bringing 17 years of experience in environmental commodities. Dania also serves on the board of the REX Association, adding a valuable industry-wide viewpoint to today's conversation.
Hi, everyone, and thanks for joining our webinar today.
Today, we're going to be addressing a topic that is set to reshape the clean energy purchasing strategies for the decade ahead. The GHG Protocol is currently undergoing a public consultation on proposed changes to its Scope 2 guidance, and stakeholders are invited to submit feedback before the 19th of December deadline. In this session, Iglika and Dania will walk us through the key revisions, explain their practical implications, and share their perspectives on what these changes mean for companies navigating the energy transition. We will then close with a call to action for stakeholders who wish to contribute to the consultation and help shape the future for Scope 2 reporting. Now I'll hand it over to Iglika.
Thank you, Lee, for this introduction. First, I would like to share light on the most important proposals to the Scope 2 revision, starting with this slide that highlights the key amendments that are proposed for the Scope 2 market-based reporting. As you know, today companies can rely on annual matching and broad political or regional boundaries when sourcing renewable attributes, but under the new proposal, we move from that to much higher precision. So hourly matching and also a shift to deliverable market boundaries. And because these changes are significant, the Greenhouse Gas Protocol also introduces several implementation tools. And the goal of these tools is to make the transition feasible. So these tools include exemption thresholds, the use of load profiles, a legacy clause for existing contracts, and phase implementation. Together, they illustrate just how fundamentally the proposal would reshape the corporate emission accounting and reporting. Okay, so moving on to one of the biggest proposal changes, hourly matching. The idea here is simple. Instead of matching renewable electricity on an annual or monthly basis, companies, they would need to match every single hour of their consumption with renewable generation from the same hour. This shift would rely much more on granular energy certificates. So it's basically moving away from the monthly certificates we use today. But with that ambition comes, of course, a challenge. So hourly matching requires advanced tracking systems. And yeah, they just don't exist yet in every market, or they're simply not widely available. Also, the proposal does recognize this gap, so it introduces exemptions for small companies, well, at least in the early stages. And overall, the goal is higher precision and transparency. Unfortunately, the practical readiness of the market varies a lot. Another big proposed change concerns physical delivery requirements. What does it mean? Well, essentially, if a company wants to make a renewable electricity claim, using something like guarantee of origin, like in Europe. The power must be produced within the so-called deliverable market boundary. Well, in practice, this means that the electricity has to originate in a place that the grid can realistically deliver the energy from. So in Europe, this would likely follow the existing bidding zones, and as you can see them on the map provided by ENSUI, they are certainly redefining the existing political boundaries. You can see that there are several bidding zones in Norway, also in Italy. And yeah, they already reflect where the electricity can flow without major constraints. So in the future, these boundaries, as you see, could become the reference point for what counts as deliverable market boundaries.
So, Iglika, on one of your points, you mentioned that some companies may be exempt from the hourly matching revision. Could you please elaborate on the proposed size or specifics of these exempt companies?
This threshold has not been defined yet. That question is actually part of the consultation survey. So the companies that might go exempt are either with 5 gigawatt hour of annually consumption, or the upper threshold that was suggested by the Greenhouse Gas Protocol is 50 gigawatt hour of annual electricity consumption, which we believe is too low. We also believe that there shouldn't be any exemption, but rather that hourly matching should not be mandatory. It should remain voluntary for all participants.
Great, thank you very much, Iglika.
Yeah.
So let's give the word to Dania now, moving on to hourly matching. So Dania, on paper, it seems like the logical evolution. Let's consume more solar energy only when the sun shines. But let's also look at the corporate buyers. Today, we have an inclusive market where medium-sized companies can buy guarantees of origin and claim 100% renewable electricity consumption. So if the new guidance were to make hourly matching mandatory, how would the scenario change for a company that isn't a Silicon Valley tech giant, for example? What are the risks for such companies?
That's basically the heart of the question and the topic that we are addressing today. So I believe that, first of all, there is the willingness here is to do something good. So they would like, the purpose is to make the system more credible and the accounting more credible and more accurate as well. So the intent is good, but I believe that, first of all, there is a misunderstanding also on how the power markets actually work. So the certificates markets, just like the power market, it's a book and claim system. And it has been also created to be able to trace the renewable origin of the electricity produced and consumed after that everything has already happened. The power market works a little bit in the same way. The TSOs have the mandate to keep the system at equilibrium. And therefore, the commercial aspect of the power market has been decoupled from that. So the TSOs have the obligation to keep the system in balance, while the market operators exchange and sell, buy and sell power contracts, also based on a sort of a book and claim mechanism. Therefore, I believe that it's wrong actually to try to bring the guarantees of origin on an hourly matching level to be close to the power market or how the power market works, because this is not how it works. Let's imagine that we, for example, a good example is Switzerland. Okay, And Switzerland has implemented what is called the full consumption disclosure. This means that for every megawatt hour that is delivered to consumers, the energy distribution companies, they have to cancel in the system guarantees of origin for whatever technology. And the guarantee of origin is issued for every megawatt hour that is produced and injected into the Swiss national grid, which means that we have an accounting that is complete. We have all the issuance that is traced, and we have all the cancellation that are traced as well. And at the end of the year, the accounting is booked. We don't have anything that is non-disclosable. So we do not have a residual mix anymore. So the location based, it doesn't exist basically anymore, because that is how it works. And this brings a lot of clarity. So during the year, there are all the exchanges, the TSOs do their job to keep the market at balance, so to avoid blackouts, and to allow each of us to switch on the light and have the electricity when it's needed. The power market exchange the power contracts in the exchanges or bilaterally, and then the guarantees of origin at the end of the year, once it is known how much electricity was delivered to all the households, we have the final numbers, then the guarantees of origin are procured and cancelled in order to close the accounting. And starting from 2027, this will be done on a quarterly basis to provide a little bit more accuracy and transparency. And in France, it is done on a monthly basis, for example, but without the full consumption disclosure. So there are intermediate steps that are still simpler to apply, but that works well enough. But to go back to your question, so I believe that it would be very undemocratic, let's say. So hourly matching is technically very fascinating, but it requires three things to function well. The smart meters everywhere, because we have to know exactly what is going on, and this, I believe, it's already the case. And then it would require complex data management softwares, and the budget also to buy certificates during scarce hours, because there will be a lot of scarce hours as well, like nighttime or winter peaks or simply dry season, or when the sun doesn't shine. So, and big tech companies can for sure afford this. But let's think about the backbone of our economy. So small, medium-sized enterprise, retail chains, manufacturers. For them, moving to such a solution is going to be very complex. It means managing 8,760 data points a year. And it will be very complex, and it will require a lot of administrative costs. So invest money to have tools to manage all this accounting, because Excel will probably reach its limit there. And the result would be that many companies might say, look, you know what, I'm going to either do the location-based only, and then if they are in a country where the residual mix is bad, they will not have any other choice, or they will have to say, okay, then I will stop buying renewable electricity because it is becoming too complex. Let's don't forget that it is a voluntary market. It's not mandatory. So I believe that it's undemocratic, because companies with a lot of means, financial means, and maybe being data-driven and being technologically already very advanced, they will be able to implement this. But other types of companies that actually represent the tissue of our economy will face major constraints, let's say. So we, Nvalue, argues that hourly matching should be voluntary, not mandatory. So that's our point about the new guidelines proposed by the Greenhouse Gas Protocol. What we are highlighting is that mandatory aspect of it. So we believe it should be voluntary, a badge of excellence for those who can, but a barrier for everyone otherwise. So that's a bit, our point here.
Great. So moving on, but still staying on the topic of hourly matching, let's look at the other side of the coin, the renewable electricity producers. It's often said that hourly matching will send a price signal to invest in technologies like storage or nighttime wind. However, in our policy position paper, we highlight that the physical electricity market already has these price signals. So, Dania, from the perspective of an investor who wants to finance a new solar park, does adding hourly price volatility to renewable electricity certificates help or drive capital away?
Well, I believe that investors, they seek stability, not additional volatility, let's say. And if we tie the value of a certificate to a specific hour, then we create a dangerous distortion. Imagine a solar park. It produces a lot at noon, and when everyone else is also producing. And with hourly matching, the value of the certificates produced those during peak hours, it will be close to zero, while the value of the certificates in other hours might skyrocket. And for a solar producer, this means that he could not profit of this added value in other hours, and he will be left with nothing. So relying only on the power market, basically. So this, I mean, it's not the right signal that we want to give. A producer should have the opportunity to fully valorize his production whenever it is injected into the grid, because it is consumed somewhere. Let's say in Europe, let's remember that the power grid is very interconnected, and when a megawatt hour is injected into the grid, it means that somebody is consuming it. And as long as all Europe does not consume 100% renewable electricity, since the grid is at balance, every megawatt hour of renewable capacity that is injected into the grid, it is consumed. So at the end of the year, the booking is booked. So the system is closed, and there are no unconsumed renewable capacity that has been injected into the grid. So the current guarantees of origin, as per it is, already works well. So we must not confuse accounting, so who paid for the green energy, with grid operations, who balance the system. And for investments, as I said, I mean, we need stable long-term PPAs and not a lottery of hourly prices. And if we take, again, I mean, I take the Swiss experience because this is what I know best. But what will be in Switzerland starting from 2027? We are having the quarterly disclosure, meaning that the electricity distribution companies, they will have to cancel guarantees of origin coming from the respective quarter for the electricity that is delivered during that quarter. And since Switzerland is a natural importer of electricity during Q1 and Q4, while it is a natural exporter of electricity during Q2 and Q3, because let's say our production infrastructure, it is naturally built to be like that. So we have a lot of water, of course, and therefore in winter we have less available, while in summer, when the snow melts and all, we have a lot more available. Being our system built like that, and since we already import electricity in Q1 and Q4, with the quarterly disclosure, we will end up not having enough Swiss guarantees of origin for those 2 quarters. And another layer of complexity, which here it relates to the last, to the question that we are going to address in a moment, but the fact that Switzerland cannot export its guarantees of origin because we do not have right now a bilateral agreement with Europe, so the Swiss guarantees of origin are not recognized in Europe. We cannot export our surplus. The Swiss producers are left with a bad surprise. So they have to either import guarantees of origin to cope with the demand during the winter hours, and they cannot sell their surplus during summer. So they end up just overpaying without the ability to optimize. And this is not the goal. And if we match the hourly matching together with the geographical also granularity, we might end up in a similar situation where there are strong price distortions. Because, for example, right now in Switzerland we have 3 prices for guarantees of origin for 2027. We have a price for just the winter quarters, which is above €8 per megawatt hour. We have a price for evenly splitted volume between every quarter. So if, for example, a customer buys 10 gigawatt hour every quarter, then it receives a flat price of 5-6 euros per megawatt hour. But this means that even if to get this price, more interesting price, this customer has to buy the same quantity every quarter, even though maybe in some quarter he doesn't have interest, like in the summer. And then we have a price for annual profile, which is much lower, maybe 2 euros, 1 euro, 3 euros. So it's much lower depending on how the market goes. So I'm saying this to try to bring a concrete example on how additional granularity, even though it's still very doable, brings already a lot of price dynamics and price distortion, because the producer, they don't know what the situation will be in 2027, and therefore they are pricing in the risk. And this is a risk that is basically translated to the customers.
So another topic that we can move on to that's also interesting to discuss is physical deliverability. So the GHG Protocol proposes restricting markets to zones where there is physical deliverability, for example, bidding zones instead of national boundaries. Dania, let's think about the multinational with offices all over Europe, perhaps with production plants in areas where the energy mix is still heavily fossil fuel based or renewables are limited. If the rule passes preventing the use of certificates coming from, say, a more decarbonized grid simply because they're outside the physical delivery boundary, how will these companies achieve their net zero targets?
I believe it is a bit, I mean, I have already elaborated a little bit on this, but simply put, they won't be able to, because it will become prohibitive in terms of costs. So it is also true that the Greenhouse Gas Protocol, it is a worldwide concept, and I believe that, as said, so it must fit for all. And in this case, I think it doesn't fit for Europe, because Europe is a very well interconnected power market, and even in the power markets, we have now algorithm calculating the prices, because it is so interconnected that it is possible to do that, and to have a price that is flattened out across the continent, because the countries are so well interconnected physically with cables, so that the electricity can transit from one bidding zone to the other. But yes, this would mean dividing, so taking into consideration the different bidding zones. Let's say Italy has several bidding zones, and Italy, for example, is also struggling with the physical infrastructure. So sometimes there is a lot of renewable production in the southern region, but it cannot reach the northern part, because simply it cannot flow through the cables that are physically connecting the south to the northern part of Italy. And the same happened in Norway too. In the very north part of Norway, you have very low electricity prices, because the cables do not allow the electricity to flow down sometimes. So if we want to apply this concept to the guarantees of origin as well, we will end up in a situation where customers that are situated in a region that has limited renewable capacity, they will fight with the other industries based in that region to buy the available renewable guarantees of origin there. So they will face probably some price squeeze. And then they will be left with no other option than either using the residual mix or applying I believe that the Greenhouse Gas Protocol consider this, and they say, okay, if you cannot find the certificates in the bidding zone, then you can extend. But here the problem are the rules. So who says that I didn't find them? When is the threshold? So what is the limit? How much should I pay or show that, I mean, if I can buy them, but I have to pay 100 euros per megawatt hour, can I apply for the exception, and can I look outside my bidding zone, or I have to pay 100 euros per megawatt hour? That is the question, because at a certain point, if I put myself in the shoes of an industrial client, I would say, look, I'm not going to pay 100 euro per megawatt hour to buy the renewable energy certificates. I would rather use the local mix, and I will say that my scope 2 is still very dirty, no? So I believe it is a bit controversial, and it does not reflect the European actual reality, also how it actually works. So it might not be the right instrument and the right solution for the European market. I don't know enough about the rest of the world, so that is what I'm saying. I mean, the Greenhouse Gas Protocol is a worldwide, it is used worldwide. Therefore, I'm advocating only for the European case, where I believe it should be avoided.
Thank you, Iglika, and thank you, Dania, for guiding us through these proposals and their wider implications. Today's session really highlights just how significantly the revisions could reshape renewable electricity procurement and corporate emissions reporting in the years ahead. As a reminder to all of our viewers today, your voice genuinely matters in this process. The GHG Protocol consultation is open, and the final standard will reflect the perspective of those who choose to participate. If only big tech companies participate, the rules will be written for them, so have your say on this. To support you, we've prepared the Nvalue GHG Protocol Survey Participation Guide, which you can download from the link in the video description. It includes our opinion on answers to key consultation questions and a brief guide that you can adapt to shape your own submission as well. You don't have to answer all 100 questions. In this guide, we just highlight several critical themes from the GHG Protocol revision proposal that will shape the future of emissions reporting and accounting. You will also receive an email with the link to our upcoming Q&A session. So we warmly invite you to join us for that discussion, in which we would really value your questions, your reflections, and your feedback. Thank you again for being here today. We hope you had an enjoyable time. We hope to see you at the next session, and thanks again to Iglika and Dania.
Thank you, Lee, and thank you, Iglika. It has been a pleasure, and thank you all that attended the webinar. It has been fun, I hope, also, not just boring. And see you soon.
Thank you. See you.
Thank you.